In this video, we're going to continue discussing risk and return, just different ways to looking at and approaching the concept of rates of return and risk. So there's something referred to as effective rates. This is a true representation of the rates and also accounts for compounding. And if we have returns that represent more than a year, we have a special formula for that. And there's also one if it's for less than a year, where T here represents the short periods in a year. So it'd be the part of a year, if you will. We could also use Excel equals effect, then put in a rate, whatever that rate might be, and then N being the time frame. This would be a time value adjusted return for a certain period of time. Nominal rates, these are really more like stated rates, right? They don't account for compounding, right? So the annualized percentage rate, APR, is the periodic effective rate multiplied by the number of payments per year. So the APR is an example of a nominal rate. Right? So in practice, again, these are the stated rates that are in a contract. They're not the actual rates that we pay because they do not take account for compounding. So now let's switch gears and talk about risk. Risk is all about uncertainty or volatility. They both describe the same concept, if you will. And we want to figure out how we measure that. So what we're going to measure is the dispersion of returns. That is, how are the things spread out? Thinking about opportunities. Are there greater ranges of opportunities to be acquired, or is it less? So risk represents the uncertainty of returns and is often measured by standard deviation. For example, Bitcoin has a higher standard deviation than the S&P 500, meaning its returns are more volatile. That volatility can be visualized through the spread of returns in a distribution chart, where greater or wider distributions indicates greater risk. So here we have AMD returns over several years here. The histogram shows returns ranging from -40 to -50, and these are probably monthly returns. Distribution shows how returns have varied over the past 5 years. Note that it really doesn't look like a normal distribution, like a bell shape. It doesn't look like that. And that's true of most individual stocks. However, we may see later that when we move to portfolios, they tend to be more normally distributed. We were talking about the comparison of Bitcoin and the S&P 500. And here we can visualize this volatility. So the Bitcoin, the blue dashed lines here, obviously are variable. They move all over the place. So historically, the range of returns and therefore prices has been kind of all over the place, up and down every month. The S&P 500, however, for the same time frame, has been a lot smoother, if you will. It has had less volatility. So total risk comprises diversifiable risk, which can be mitigated holding a diversified, if you hold a diversified portfolio, and non-diversifiable risk, which this is risk that's inherent in the market. The stock market pays investors for taking risks, but only necessary risks. If it's not needed, then you don't need to get paid for it. That is why we're really only interested in the non-diversifiable risk. This is the risk that we cannot eliminate. For instance, if you hold Tesla and Procter & Gamble stocks, this reduces the impact of any of the company-specific risks within those two particular companies, but it doesn't eliminate risk like economic recessions or political risks that we might be subjected to. Statistics is all about averages. So as the sample sizes get bigger, get larger, the returns and risk move closer to what we might refer to as being a normal distribution. As we look at more returns and more stocks, that average becomes more compact or closer to the average of the population. So when we're gathering historical data for stocks in particular, often we're going to use a 60-month return database to help describe the returns and the risk of those stocks and or the market. So here's that picture of the normal distribution that we were talking about. And as you can see here, the A, it has this curvilinear shape, right? Sort of looks a little bit like a bell. But notice that the distance from end to end is rather short, rather compact. So we would say the distribution A has the least amount of risk because there are more returns that are closer to the middle. Where if you look at C, you see that actually the average is the same. It's in the same area. However, there's lots more opportunity for a wider range of returns. Said another way, there's a greater probability or possibility of having higher positive return, but there's also a higher possibility of having lower returns. So again, as you can see here, A has a narrower distribution and a higher mean, right? C has a much wider distribution. This means that there are more potential outcomes. That is a greater variability or risk. Going back to our picture of AMD, that histogram for 40 years of monthly returns, again, the line reflects close to a normal distribution. It's not perfect. So in this case, we can say that these returns are very close to being normally distributed. So how can we measure risk? We typically use a measure of statistics called standard deviation. We can do this with the probabilities of future returns. We can also do it with historical returns. And as you see here, we have Excel formulas that can help us calculate the standard deviation of a data set. So this standard deviation measures the overall uncertainty in the data. Again, sometimes we refer to this as total risk or standalone risk of the asset. It includes both the market risk, that is the non-diversifiable risk, and the company-specific risk or the diversifiable risk. So the price of risk, right? The risk is the thing that we're compensated for, right? If we did not want risk, we would just all purchase risk-free assets. The greater the risk, the more we want to be paid. Of course, we don't know today if we will actually get that return in the future. And that's part of the uncertainty. So much of the historical data for asset classes shows this relationship between risk and return. We call it the risk-return trade-off. As risks increase, we want to be paid more. If things get riskier that you own, they become less valuable because now there's a chance that what you were expected to get might not happen. Why won't returns, why might they not really compensate us for all the risk across all the assets, right? So there may be variables that impact value in the future and therefore returns that we just don't know, right? We're just not aware of. Past returns do not imply anything about future returns. However, historical risk takes time to, in quotes, work its way out into changes, to changing. So past returns don't reflect much about future returns. However, historical risk does have some relationship to current risk. So kind of to wrap up here, risk and return are two sides of the same coin. Understanding the components allows us to understand those relationships and make decisions so that we can achieve our financial objectives. So what do we need to think about? Right? There are challenges we have when we gather any data, right? For some assets, investors might not expect the same kinds of risk-return relationships for assets in the future as they do today, right? We can change our expectations over time. So again, investor expectations are key to understanding how these risk and return relationships combine. Some risk can be diversified away when looking at a portfolio rather than one asset. So diversifiable risk might be different across different assets. And finally, investors might just price the risk of one asset differently than they do the risk of another. Again, just to kind of come back to the last statement here, right? Investor expectations is key. You and I drive the car here, right? What we do and the actions we take impact the marketplaces. Look forward to talking to you the next time. Bye-bye.